Hello. I wanted to talk a little bit about financial and data analysis, kind of as it's directed towards managerial accounting. So let me go ahead and pull up and share the screen. Okay, so this is something that I prepared, but it's a good little example of data analysis, kind of from a perspective again of the managerial accounting class and kind of how that would be handled. Okay, so I started here. I created a little income statement, and it's for 2 years. It's for 2019 and 2020. And I have the normal accounts. I have sales. You remember is a revenue. Cost of goods sold would be the cost of the items that were sold, and gross profit, or sometimes you'll see it as gross margin, would be basically the markup on the goods that were sold. And then you have your operating expenses, such as your selling expenses, which would be like your sales salaries and maybe if you have stores, the cost of the stores being open, the cost related to sales. You have general, which would be more expenses that cover kind of your company on the whole. And then administrative would be more of your executive expenses. Now, and of course, gross profit minus your operating expenses equals operating income, which would be the income that you've earned basically from your main business operations. And then you take out income tax expense, which in this example here is 30%, and you come down to net income. Now, this is a very basic example, but I thought that by giving you a basic example, you could kind of see what you would do in some terms of data analysis or data analytics and examining the data that you would do, and you could do it with a much larger example as well. So let's look at a couple of things. The first thing I do is I take 2020 minus 2019, and we look at the total difference. So you see that sales increased by 40,000, cost of goods sold by 30, gross profit by 10. You see there was an increase in pretty much all of the expenses. Operating income was down, income tax expense was down, and so was net income. So there's a couple of different ways there's a few different ways to analyze a financial statement. One is horizontal analysis, which means that you're looking at comparing different dates. And so by coming up with the dollar value differences from 2020 to 2019 and the percentage differences um, here, these two would be more horizontal analysis. They would be comparing one date with another. How did things change? Um, and basically, how I did the percentage difference was I took the total difference and divided it by the initial year. So what you see here is that sales increased by 20%, $40,000 or 20% from 2019 to 2020. And so this is horizontal analysis, looking at multiple 2 years or multiple years, even up to 5 years, and looking at the difference from a dollar value standpoint and a difference from a percentage standpoint. Now, vertical analysis is comparing the numbers against kind of a bar or a set number. Now, what I did here was I did common size financial statements. And in common size financial statements, what you do from the income statement is you look at sales as 100% and you look at everything on there as a percentage of sales. So you see, like, for example, um, and you see that sales again is 100% in both years. And like, for example, cost of goods sold is 60% of sales. Gross profit is 40% of sales. Every number on the income statement is examined as a percentage of sales. And so, um, and so basically what I did was I just took, um, like for 2019, I took cost of goods sold, divided it by the sales total, and it gave me 60%. The cost of goods sold was 60% of sales. And I did that for every single number on the income statement here. Now, here's the thing. What do you gain from vertical or horizontal analysis? And this is true data analytics. This is true data analysis. Um, what you gain by this is you get a little bit deeper view of the numbers. And I think looking at percentage differences or common size financial statements tells you more than just looking at the statements themselves or even the dollar value differences. Look at some, let me just point out a few things on here. And this is kind of what, if you were examining the data, what you would look at. And I used to, when I was a corporate controller, I used to do a lot of this. For example, sales is the biggest driver of cost in an organization. When sales go higher, a lot of your expenses go higher automatically. When sales drop, a lot of your expenses drop. Less shipping, less inventory, less people, you name it. There's just a lot less that's needed when sales drop. When sales go up, you got to have more people to take care of it, to take care of your customers, to ship it, more shipping costs. So sales drives cost across the company. And that's one of the reasons that they are accounted for as 100% here. But notice that you've got some expenses increasing greater than sales. And if a cost is rising equal to sales, then you can understand it. But if a cost is rising greater than sales, that would be something that automatically you should look at. And so, like in this case, cost of goods sold went up 25%, sales only went up 20. Notice too, just looking at the bottom line, notice that our sales were up by $40,000 or 20%, but yet our net income dropped by 28%. So if sales are going up, but net income's dropping, what is causing that? I mean, that would be the very first thing that I would notice looking at this. And then I would say, okay, cost of goods sold was up. So cost of goods sold was up. So that's part of it. And then you can also see it is that basically cost of goods sold increased as a percentage of sales, went up from 60% to 62.5%. So basically it caused our gross profit to drop. Notice that selling expenses were up, but they did not increase as much as sales. So selling expenses were handled well. And notice here too, they were 15% of sales, then they dropped to 14.58% of sales. And so kind of if sales go up 20%, that's kind of a threshold. We're looking at basically, what cost rose higher than 20%. If cost rose less than 20%, we could say that we did a good job with that expense. But notice like general expenses was right on with sales. A big one is notice administrative expenses. We're up 66.67%. That would be like an automatic red flag. This is way over what it was before. This is a huge increase. And notice that it went from 7.5% of sales up to almost 10.5% of sales. Income tax expense dropped, but it really doesn't matter because income tax expense is based on your operating income. But net income was down 28%. So I would identify, okay, the two areas that were most responsible for this was an increase in cost of goods sold and an increase in administrative expenses. We did a good job with our selling expenses, but it was not enough to offset gains in administrative and cost of goods sold. So the first thing I would do is I would look at this and I would want to look into why did cost of goods sold increase and why did administrative expenses increase? Was it some kind of an error? Are our suppliers all of a sudden charging us more here? Was there a bonus payout? What caused these numbers to be so high? And I would look at, is this something that's going to continue? Or is this something that was a one-time thing? Or was it an error that we need to correct? What caused this to occur? This is the kind of real world examination of data that accountants do, but also managers do a lot of. Or if you're a small business owner would look at this. Now, if we were looking at this is, like I said, a very basic example. But if we were looking at this from a company standpoint, we might have 5 years out here. We might have 2016, 17, 18, 19, and 20. And we'd look at, okay, what are the changes over that 5 years? And we'd look for positive trends and negative trends in the data. Positive trends would be in our favor, they would be increasing income. Negative trends would be not in our favor and they would be decreasing income, like expenses rising faster than sales or expenses continuing to rise that should be more static or not increasing as fast as they are. These would be the kind of things we would look at. This would be the kind of information that we could gather from it. And like I said, we would typically, these are more, general expense categories, or more kind of more condensed expense categories. We could break this out. We could list all the expenses, rent and salaries and everything, and break it down. And we could really do a good analysis of how have things changed from year to year? What are positive and negative trends? And it would let you know what expenses do you need to look at. I've just found that it's especially useful for examining expenses and how they are reacting to certain changes in sales, what expenses are growing at too fast a pace or faster than they should, and that we need to examine further. So I just wanted to point this out and kind of go over a little bit of data analysis and kind of how it's done. And I hope this is helpful. And like I said, this is a very real world exercise right here. If you're in accounting, management, or if you own your own business, this is extremely helpful to know how to do. Thank you and have a great day. Bye bye.